Hello again from Core Wealth. We're going to be going through what happened in financial markets for the month of February 2024. So if we start off with the United States, earnings for their companies for 2023 started coming out, and for the year as a whole, on average earnings were up 8%, which is much better than was expected. Most people expected it to be flat for the year, so things grew faster than expected. A company like Nvidia, one of the chip makers for artificial intelligence, went up as much as $277 billion in one day because their earnings were better than expected. On the other side of the world, if we have a look at China, China has been trying to stimulate their economy. Their stock market has been down strongly over the last 4 months, and these stimulus factors really came through, and the market appreciated them. And in February, their stock markets were up around 10% just in 1 month. So while stock markets have been performing well in the US particularly, we have seen that inflation is not really under control. It was a big driver. The market was up strongly thinking that inflation was under control at the end of last year, but now there are signs there continues to be strong job growth, and wage pressure continues to be high in the US. Add to that the oil price has gone up slightly again. These are all negatives for inflation and could mean that interest rates don't come down as quickly as was expected. Then the second biggest stock market in the world is actually in Japan. And we're going to be talking a little bit about that later on, but suffice to say, we've seen the Japanese stock market reach an all-time high. The last time was back in the late 80s, and some interesting things happening in that economy and on that stock market. So for South African investors, the South African stock market has been quite soft so far this year, down about 5%, just on the back of weaker earnings coming through after a very tough economic year in 2023. And then also the commodity cycle being quite soft at the moment. And then lastly, we saw some news, quite a good budget that was delivered by our Minister of Finance, and they have a mechanism in place over the next 3 years to further reduce government debt by about 150 billion, which is in the long run we think is going to be good for our economy. So let's have a look at what markets actually did. This table is in US dollars, and we can see equity markets for the month up strongly, developed markets doing very well, but then China, you can see at the bottom there, up over 9% for the month, which led, if you look further to the right at the 1 year figures, we can see that developed markets doing very well, especially the US and Japan was the best place to have been over the last year. Emerging markets a lot softer, and that was because China was actually negative over the last year. Over the longer term, very interesting, the US has been really the winner over the last 10 and 15 years. Strong returns from some of the tech companies especially. But over the 15 years, the Japanese equity market's still giving you over 10% return per year in US dollar terms. So if we have a look at markets in South Africa and in South African rands, we can see local equities down, not just for the month, but also year to date and over the last year. The 5-year number on South African equities not looking too bad, but the 15-year number quite pleasing at just over 13%, which is almost 8% ahead of inflation per year over the last 15 years. Listed property market has had a really strong bounce in the last year, and even the last 3 years, up almost 15% over that period. Then lastly, just a comment on our currencies, or our currency against other currencies, and we can see over the last 15 years the rand has depreciated on average by 4.4% against the dollar, and slightly less against the pound and the euro. Sometimes we often lose sight of that when we get caught up in how volatile our currency is from one day to the next. So if we have a look at how is this translated into performance for our clients in the strategies that we run. This first table just shows our global US dollar strategies, first launched in November 2016, and a really nice picture there, some good outperformance both over the short term, everything green against our peers, and quite importantly, over the last year, our growth strategy has given almost 13% in dollars. So a really good comeback after 2022 was a very, very tough year and quite a negative year. But since inception, some really nice returns and green all around versus the peers, which we're very happy about. The next table has a look at our global strategies, but in British sterling or pounds. And we can see these strategies still lagging the peers slightly over the last year, but some nice absolute returns. This strategy is a lot younger, is only just over or heading towards 2.5 years old now. But over the last 2 years and since inception, the strategy is nicely ahead of its peers as well. So here we have a look at the South African models, looking at how they've performed over the last year. A bit more red than we're used to, but most of it in the short term over the last year. And that's just been a function of more valuation-driven strategies not being rewarded over that period. But if we look at the 3-year number, still healthily ahead of the peers, and that includes the tough last year that many of those models have had. But then the longer term numbers still looking very, very healthy, and the since inception figures all healthily ahead of their peers. Did you know that the Japanese stock market is the second biggest stock market in the world at the moment? That's something that often we're oblivious to, just because Japan is a relatively small island on the side of China. What we're going to unpack now are just some of the things that we've seen in the Japanese stock market, and the reason that we've been overweight for a little while now, and that has started to pay off quite handsomely in clients' portfolios. So if you have a look at these two graphs on this page, the one on the left just shows how the Japanese stock market peaked, and it was in quite a bubble at the time, the blue line, at just over 35,000 way back in the late 80s. And for many, many years, in fact, a couple of decades, was well negative of that. But we saw it turn around in the sort of mid-2000s, and it has now reached an all-time high, higher than what it was back then. It's also interesting, the graph on the right just shows how the Japanese stock market has performed since the end of the what was called the global bear market at the time, October 2022. The S&P 500 in the US is up 31.4% since that time. The Japanese stock market's up nearly 40% over that same period. This next slide just has a look at how cheap or expensive the Japanese stock market is. And the table on the left just has a look at the Japanese stock market through time, going all the way back to 2004, and looks at its price earnings ratio, a measure of how cheap or expensive stocks are in the market. And you can see that it has bounced around a lot, but at the moment it's trading at just over 15, which is actually bang on its long-term average. So compared to its own history, it's not cheap or expensive. Whereas if you compare that to the S&P 500, it's trading at over 20 times. So a lot more expensive than the Japanese stock market, and a lot more expensive than its long-term average as well. And then lastly, on the right-hand side, another measure of how expensive a stock is its price to book ratio. Now, in 1989, when they reached their previous high, the average price to book ratio was 8.1 times. Whereas now, today, it's only 2.1 times. So the stock market has had a strong run, but the underlying shares are not at all expensive. So this next slide just has a look at what the earnings of companies have been like. Japan actually was in a technical recession from an economic growth point of view at the end of last year, but this slide just shows that even with that, companies have continued to generate better profits. And that's because they're not just reliant on the Japanese population. They're also very big players in the global sense. Think of brands like Toyota and Sony, who trade with the world as a whole and not just Japan. Right, this graph's going to show us why Japan can be such a small country geographically, but yet have such a big economy. It has one of the biggest economies in the world. The graph on the left-hand side just shows the level of manufacturing that's happening. The orange line been quite flat over the last couple of years, and the bluey colored line shows what is happening with the use of cardboard boxes or corrugated cardboard. As the use of corrugated cardboard goes up, that means more shipments are happening, and that's why we've seen that picking up. And on the back of that, we expect global manufacturing to start increasing as well, which will be good for Japan's economy and good for the companies listed there. On the right-hand side, we just have a look at the level of cash that the average Japanese person has at the moment. And we can see that they've got way more money in cash than they do in shares, the orange line, or the orange bar, and it's a lot different to what you see in the US or in Europe. And there's a new incentive out to try and change that, and we think that could push the average Japanese person to have less in cash and move more money into the stock market, which will be a positive or a tailwind for the stock market because there'll be more demand. If we also have a look at what is expected in terms of future returns from the Japanese stock market, things also look very attractive. This graph on the left rather, just shows the top 10 developed countries around the world and the expected returns in US dollars ahead of inflation over the next 10 years. And you can see Japan at some 7.3%, quite healthy returns expected. The other thing is that global investors are starting to pick up on this trend. And what we've seen is on the graph on the right is that over the last, or since 2020, we've seen a net inflow into the Japanese stock market, whereas the years prior to that, the 4 years prior to that, there was a strong negative outflow of investors from the Japanese stock market. Take all these factors together, we think the outlook for Japan is quite attractive. We've got significant overweight position in our global strategies to Japan compared to our peers, and it's been something that's been a really good positive to clients' portfolios over the last couple of months. That concludes today's video. Thanks very much for watching. If you've got any questions, please come and visit us. By the time this video goes out, we will have completed our office upgrade. We've been in our offices for a while, so we've had a few coats of paint put in and a few changes to the decor, so come and have a look. We'd love to see you.